In this video, I'm going to show you a compilation of the 10 best strategies that you can use for trading. Some of them are for scalping or day trading, and others you can use in all time frames and types of financial assets. Let's see what the strategies are. The first thing we have to do is select an exponential moving average. We will put this exponential moving average of 21 periods, but on a chart larger than the one we operate in this case. As I will trade the 5-minute chart, we will put it on the 30-minute chart. In addition, we will change the color to white and increase the thickness to the maximum. The next thing we will have to do is select the MACD indicator. To this indicator, we will put the parameters of 3, 10, 16. We will deactivate the signal line and the histogram. Also within the indicator, we will add an exponential moving average. To do that, we simply go to these 3 points and hit Add Indicator, find the EMA, and select it. Once selected, we're going to see that the EMA is inside the MACD. All that remains is to configure it. We will configure it for 50 periods, and in source, we will put that we want it in the MACD line. In addition, we will change the color to white and we will increase the thickness a little. Let's look at an example of when to buy. We will execute a buy trade when the price is above the EMA and also the blue MACD line crosses its 50 EMA from bottom to top. We will put our stop loss below the last low and our take profit in a risk-benefit ratio of 2 to 1. That is, we risk 1 to try to get 2. In the case of wanting to carry out a sell operation, we will wait for the price to be below the EMA and also for the blue line of the MACD to cross its EMA of 50 from top to bottom. We will put our stop loss above the last high and our take profit in a risk-benefit ratio of 2 to 1. That is, we risk 1 to try to get 2. For both buying and selling, we will avoid trading if the 50-period EMA is flat, as it may be in this case. We will try as much as possible to have enough angle as it can be in this case. The first thing we will have to do is select 3 exponential moving averages. But since the program that I use to carry out the strategy is limited to a maximum of 3 indicators, we will select this indicator that already has the 3 moving averages in one. We will set up the moving averages with the following periods 4, 9, and 18. Then we will change the colors and weights as follows. Once the moving averages have been selected, we are going to look for the RSI indicator. This indicator, we will leave it with the parameters that come by default, and we will deactivate this moving average. With the help of the horizontal line tool, we will mark the values of 60 and 40 on the RSI. Finally, we will select the ADX indicator. Leave it with the default parameters and change the color of the ADX line to white. Let's see how to use this strategy. To carry out a buy operation, we must wait for the RSI line to cross the value of 60 from below to above. If it does, we will notice that the moving averages are separating in the following order: green on top, red in the middle, and blue on the bottom. If this is fulfilled, we will see that the green line of the ADX is above 20 and the red line of the ADX is below 20. If this is finally fulfilled, we will carry out the buy operation. We will place our stop loss below the blue EMA and our take profit at the support and resistance zones. In the case of wanting to carry out a sell operation, we must wait for the RSI line to cross the value of 40 from top to bottom. If it does, we will notice that the moving averages are separating in the following order: green at the bottom, red in the middle, and blue at the top. If this is fulfilled, we will see that the red line of the ADX is above 20 and the green line of the ADX is below 20. If this is finally fulfilled, we will carry out the sell operation. We will place our stop loss above the blue EMA and our take profit at the support and resistance zones. If in addition, the ADX white line is above 20, the signal to buy or sell will be stronger. The first thing we will have to do is select an exponential moving average. This EMA, we will put it in 13 periods, we will change the color to light blue, and we will increase the thickness a little. Then we will have to select the momentum indicator. We will put this indicator with a value of 14. And with the help of the horizontal line tool, we will mark a line at the value of 100 of the momentum indicator. As I said, this strategy is really simple. To make a buy trade, all we have to do is wait for the momentum line to cross from below to above its 100 line, and at that very moment, a candlestick crosses the 13-period EMA from below to above. If this is true, we will carry out the buy operation. We will put our stop at the last great low and our take profit at a risk-benefit ratio of at least 1.5 to 1. That is, we risk 1 to try to win 1.5. To make a sell trade, all we have to do is wait for the momentum line to cross its 100 line from top to bottom, and at that very moment, a candlestick crosses the 13-period EMA from top to bottom. If this is true, we will perform the sell operation. We will put our stop at the last high and our take profit at a risk-benefit ratio of at least 1.5 to 1. That is, we risk 1 to try to win 1.5. Both for the buy and sell operation, it is very important that the candle crosses the EMA of 13, that is, that the candle opens on one side of the EMA and closes on the other side. If this is not the case, it is better do not perform the operation. Alexander Elder makes reference in his book to what was established by Charles Dow. The market has three trends: long, medium, and short-term trend. Robert Reed, a technician from the 30s of the last century, compares these three tendencies as a tide, a wave, and a ripple of the sea. He tells us that we have to operate with the tide, taking advantage of the waves for entry and ignoring the ripples. The time frame in which the trader wants to operate is decided by himself. The triple screen strategy uses an intermediate time frame where the orders will be executed. Example: if a trader trades long-term, he can use a weekly chart as his long magnitude time frame, one-day charts will be his medium magnitude time frame, and one-hour charts his short magnitude time frame. If you trade intraday, you can use the one-day charts as your long magnitude time frame. The 1-hour charts will be your medium magnitude time frame, and the 5-minute charts your short magnitude time frame. For this video, we are going to trade as if we were trading intraday. First screen. The first screen begins by analyzing a long magnitude time frame. In this case, as we will trade intraday, the long magnitude chart would be 1 day, leaving aside the larger charts. For this first screen, the indicator to use will be a trend following indicator like the MACD, so we will select it. We will put the parameters of 3:15:1. We will deactivate the histogram. And we will change the line type to signal line by histogram line. Also, we will change the color to white. In case you did not know, the MACD moving average convergence divergence measures the divergence and convergence of the price of an asset in a market, allowing us to analyze the behavior of the price and the market trend. The MACD is made up of two lines and a histogram. The first is the MACD line. It is a measure of how two moving averages come together and move apart. By subtracting the position of these two averages, you get the main MACD line. MACD formula is equals to EMA, number of periods, minus EMA, number of periods. The second line is the signal line. It is nothing more than an exponential moving average of the first line, almost always 9 periods, and which will intersect every so often with the main line. Then we have the MACD histogram, which just measures the distance between the two MACD curves. If the bars are above 0, so the uptrend will most likely continue. On the other hand, if it is below 0, it means that the bears rule. In short, we have two moving averages, we subtract them and we get a line. To that line we calculate another moving average and we obtain a second line. If we subtract both lines, we have the histogram. When the MACD line crosses the signal line from the bottom up, it could be a buy signal. And when the MACD line crosses the signal line from top to bottom, it could be a sell signal. Of course, the MACD indicator can be used in many other ways. The MACD is the indicator that the author recommends, and it is based on the slopes of its last two bars. If they go up, then the trend will be bullish. If they go down, it will be a bearish trend. A good buy signal would be if its slope turns up when it is below the 0 line. A good sell signal would be if its slope turns down when it is above the 0 line. Other trend-following indicators can be the slopes of a moving average of 13 or the ADX indicator if you prefer. In conclusion, for this first screen, we will determine the market trend. A good trader always swims with the tide. Second screen. On the second screen, we are going to move to a 1-hour chart. The second screen uses an oscillator that aims to identify rallies for market entry. In our case, we are going to use the Elders Force Index (FE) oscillator, which we are going to set with the parameter of 2. The Elders Force Index (FE) measures the power behind a price movement using price and volume. The indicator can also be used to identify potential price reversals and corrections. The EFI is an oscillator that fluctuates between positive and negative values, above and below a 0 line. If the EFI is above 0, it means that it is overbought and the price may go down. And if the EFI is below 0, it means that it is oversold and the price may go up. If the daily trend is up, we will wait for the EFI to be at the oversold level on the hourly chart and make a rally. If the daily trend is down, we will wait for the EFI to be at the overbought level on the hourly chart and make a rally. In conclusion, for this second screen we will use an oscillator, which will help us find buy signals when there is a downward cut on the hourly chart in a daily bullish trend and sell signals when there is an hourly rise in a daily downtrend. Third screen. On the third screen, we are going to move on to the 5-minute chart. For this third screen, no chart or indicator is needed. The third screen is a technique that we have to apply. This screen is also known as the moving buy-stop technique for uptrends and the moving sell-stop technique for downtrends. When on the first screen the slope of the MACD indicates a bearish trend, and on the second screen the force index oscillator enters its overbought zone, then the moving stop-sell technique will be activated. We will execute a sell order if the price exceeds the previous minimum. In such a way that if the price continues to fall, the sell order will be executed. If the price continues to rise, the order will not be touched. In that case, we will raise the entry price to the next low until the sell order is executed, or until the daily trend changes. We will place our stop loss on the last high and our take profit on the support and resistance zones. On the other hand, when on the first screen, the slope of the MACD indicates an uptrend, and on the second screen the force index oscillator enters its oversold zone, then the moving stop-buy technique will be activated. We will execute a buy order. Buy if the price exceeds the high of the previous hour, in such a way that if the price continues to rise, the order will be executed. If the price continues to drop, the order will not be touched. The first thing we will have to do is select 3 exponential moving averages. The first EMA, we will put 21 periods. We will change the color to yellow, and we will slightly increase the thickness. The second EMA, we will put it at 126 periods. We will change its color to orange, and we will increase its thickness to 3. Finally, the third EMA, we will make it 252 periods. We will change the color to white, and we will increase the thickness to the maximum. Before starting with the strategy, I have to clarify that we will not carry out operations if the three EMAs are crossing each other, as this could be the case, since this would indicate that the price is in a lateral trend and there may be many losing operations. Having said that, let's start explaining the strategy. To carry out a buy operation, we must wait for the price to be above the white EMA, and an engulfing candle is formed at the orange EMA. In case you do not know what an engulfing candle is, it is simply a candle that engulfs to another. In this case, we want a bullish engulfing candle. That is, a large green candle that opens below the green one and closes above it. This would be the best case. The bullish engulfing candle may not be perfect. Also, the yellow EMA must be above the orange EMA. If this happens and the EMAs are not crossing, we will execute the buy operation. We will place our stop loss below this candlestick pattern and our take profit at the support and resistance zones, with a minimum risk-benefit ratio of 1:1. In the case of wanting to carry out a sell operation, we must wait for the price to be below the white EMA, and an engulfing candle is formed at the orange EMA. In this case, we want a bearish engulfing candle, that is, a large red candle that opens above the green one and closes below it. This would be the best case. The bearish engulfing candle may not be perfect. Also, the yellow EMA must be below the orange EMA. If this happens and the EMAs are not crossing, we will execute the sell operation. We will place our stop loss above this candlestick pattern and our take profit at the support and resistance zones, with a minimum risk-benefit ratio of 1:1. This is a really simple strategy, but very useful and effective since we will be operating directly with what the candles tell us. The trend is simply the direction in which the price is moving. This trend can be downtrend, uptrend, neutral, or side trend. In trading, we can profit from any of these trends. But how do you draw a trend line? A trend line is drawn by joining two or more points on the chart. If the points to join are getting higher and higher, then it will be an uptrend. If the points are getting lower and lower, it will be a downtrend. And if the points are at the same height, then it will be a neutral trend. The more points touch the trend line, the stronger that trend will be. When we draw the trend lines, we will do it from left to right. The first thing we have to do is find the 2 points of our trend line. In this example, we will do it with an uptrend, so we will look for 2 higher and higher grand lows. A good support point is one that has 2 higher candles to its right and left, leaving it as the tip of an arrow. We'll select the line tool and plot that trend. We will wait for the price to touch that trend line again. If the price touches it, we will execute a buy trade. We will put our stop loss a little below this line, and to put our take profit, we will measure with a rectangle the distance from one of the highs to the line. Then we will place that rectangle in the place where we made the purchase, and that will be our take profit. If we are a bit more conservative, we can put our take profit in the middle of that rectangle. In the case of a sell trade, we will look for 2 big highs getting lower and lower. We'll select the line tool and plot that trend. We will wait for the price to touch that trend line again. If it does, we will execute a sell trade. We will put our stop loss a little above this line, and to put our take profit, we will measure with a rectangle the distance from one of the lows to the line. Then we will place that rectangle in the place where we carry out the sell operation, and that will be our take profit. If we are a bit more conservative, we can put our take profit in the middle of that rectangle. The first thing we will do is select two exponential moving averages. The first we will put 28 periods. We will change the color to yellow and increase the thickness a little. This will be a fast moving average. The second EMA, we will put it at 100 periods. We will change the color to black, and we will increase the thickness to the maximum. This moving average will be the slow moving average, since it has information from many more periods. The strategy is really simple. To carry out a buy operation, we will have to wait for the yellow EMA to cross the black one from the bottom up. At that time, we will execute the buy operation. We will put our stop at 50 pips if we are using the 1-hour chart and at 100 pips if we are using the 4-hour chart, and a take profit of 2 to 1, that is, twice our stop loss. If you don't know how to measure pips, simply select the risk-benefit measurement tool and in the settings, where it says ticks at the stop level, put 500 if we are on the 1-hour chart, and put 1000 if we are on the 4-hour chart. Done, it only remains to put this in the place where we carry out the buy operation and adjust the take profit so that it is 2 to 1. To carry out a sell operation, we will have to wait for the yellow EMA to cross the black one from top to bottom. At that time, we will execute the sell operation. We will set our stop loss at 50 pips if we are using the 1-hour chart and at 100 pips if we are using the 4-hour chart, and a take profit of 2 to 1, that is, twice our stop loss. If you don't know how to measure pips, simply select the risk and benefit measurement tool in settings, where it says ticks at the stop level. Put 500 if we are on the 1-hour chart, and put 1000 if we are on the 4-hour chart. Done. All that remains is to put this in the place where we carry out the sell operation and adjust the take profit so that it is 2 to 1. It is necessary to clarify that it is possible that we have more failed operations than successful ones, but thanks to our risk-benefit ratio of 2 to 1, we will end up making money, since when we win, we will be winning twice what we lose. The first thing we will have to select will be the 15 exponential moving averages, but because the platform I use to analyze TradingView only allows me to put up to 3 indicators, let's look for this indicator that comes with 5 exponential moving averages. So putting 3 of these, we would already have 15. We will add the following periods to the first one: 6, 8, 10, 12, and 14. We will change the color of all the EMAs to pink, and we will leave the thickness to a minimum. We will also deactivate these triangles that the indicator brings. The next group of EMAs, we will put them with the following periods: 19, 24, 29, 34, and 39. We will change the color of all the EMAs to light blue, and we will leave the thickness to the minimum. We will also deactivate the triangles that the indicator brings. Finally, to the last group of EMAs, we will put the following periods: 44, 51, 58, 65, and 72. We will change the color of all the EMAs to green, and we will leave the thickness to the minimum. We will also disable the triangles. The strategy is really simple. We will carry out a buy operation when all the pink EMAs cross all the green EMAs from top to bottom, and also one of the light blue EMAs is below all the green EMAs. If this happens, we will carry out the buy operation. We will put our stop loss a little below the point where we bought, if possible below the last low, and our take profit in a risk-benefit ratio of 1.5 to 1. In the case of wanting to carry out a sell operation, We will carry it out when all the pink EMAs cross all the green EMAs from bottom to top, and also one of the light blue EMAs is above all the green EMAs. If this happens, we will carry out the sell operation. We will put our stop loss a little above the point where we made the operation, if possible above the last high, and our take profit in a risk-benefit ratio of 1.5 to 1. At first, this strategy seems somewhat contradictory, because we usually buy when one EMA crosses another from the bottom up, and we sell when one EMA crosses another from top to bottom. The thing is that this strategy uses trend exhaustion. That is, after all the EMAs have crossed into the green, there should be a correction in the price and go up or down a bit. In case you don't know, Heikin Ashi candles are very similar to Japanese candles, and they serve to simplify a normal Japanese candlestick chart, but smoother. To select them, we simply display here and select them. Then we will have to put the stochastic indicator, we will put it with the parameters of 533. We will change the color of the signal line to white and the stochastic line to red. Finally, we will have to select the ADX indicator. This indicator, we will leave it in 14 periods. We will change the color of the ADX line to white and set the trend level to 22. To carry out a buy operation, we must find two consecutive green candles and make sure that the green line and the white line of the ADX are above 22, and the red line is below 22. If this is true, finally we must look that the red line of the stochastic is above the white line with an upward slope. If all this is fulfilled, we will carry out a buy operation. But first, we will change the type of chart again to the normal candlesticks, since being in the Heikin Ashi candlestick chart could confuse us. We will place our stop loss below the last low and our take profit at the support and resistance zones, as long as we have a risk-benefit ratio of at least 1 to 1. To carry out a sell operation, we must find two consecutive red candles and make sure that the red line and the white line of the ADX are above 22, and the green line is below 22. If this is true, finally we must look that the red line of the stochastic is below the white line with a downward slope. If all this is fulfilled, we will carry out a sell operation. But first, we will change the type of chart again to the normal candlesticks, since being in the Heikin Ashi candlestick chart could confuse us. We will place our stop loss above the latest high and our take profit at the support and resistance zones, as long as we have a risk-benefit ratio of at least 1 to 1. The first thing we will have to do is select the CCI indicator and put it with a parameter of 200. We will deactivate the background and the upper and lower lines. The Commodity Channel Index, CCI, is an oscillator that measures the force behind a price movement. In its simplest form, it allows us to judge whether these forces are trending up or down. In this aspect, the CCI indicator has some similarities with the momentum indicator. The value of these indicators oscillates on both sides of the zero line. A high CCI indicates that prices are above average. A CCI rising to these levels indicates increasing strength. A low CCI indicates that the price is below average. This is an indication of weakness. Then you will have to select 3 exponential moving averages, but because the program I used does not allow us to put more than 3 indicators, we will put this one here, which already has the 3 moving averages included in a single indicator. The first one we will configure with 10 periods. We will put red color, and we will raise the thickness to 2. The second moving average, we will put it of 21 periods. We will put blue color, and we will raise the thickness to 2. Finally, the third moving average, we will put it of 50 periods. We will put black color, and we will raise the thickness to 3. Once we have everything configured, we will explain when we will make buy operations. We will carry out a buy operation when the CCI is above its zero line, and also the red EMA is above the blue and black with very little distance between them. That is, the red almost touching the blue. Also, the price must be above the 50 EMA. If this is fulfilled, we will perform the operation. We will place our stop loss below the last low, and our take profit in the support and resistance zones with a minimum risk-benefit ratio of 1:1. In the case of wanting to carry out a sell operation, we will do it when the CCI is below its zero line, and also the red EMA is below the blue and black with very little distance between them. That is, the red almost touching the blue. Also, the price must be below the 50 EMA. If this is fulfilled, we will perform the operation. We will place our stop loss above the last high, and our take profit in the support and resistance zones with a minimum risk-benefit ratio of 1:1. Let's see some more examples. And ready, I hope this strategy has been useful to you. Do not forget that before trying it with real money, you need to try it in a demo account so that you can put it into practice by yourself. Do not forget to subscribe so as not to miss any strategy, as we upload the best strategies every week.